Hi there, this is Alvin from Dr. Wealth. Recently, I came across a very interesting list of stocks that was generated by Goldman Sachs. The analyst team went to analyze the winners of the S&P 500 component stocks, and they realized that, which is not a surprise, majority of the gains were driven by the big tech stocks, or so-called the Magnificent Seven, as shown in the screen here. And they found that one of the commonality was that they all were able to grow more than 10% annually in terms of their revenue growth, right? So they were able to sustain that more than 10% growth for a long period of time. And that was what separates them from the rest of the S&P 500 component stocks. So Goldman Sachs were thinking that, hey, if we can screen out of these 7 stocks that are pretty well known already, what other stocks can fit their bill? And maybe those are the stocks that can become the next generation of a growth driver for the S&P 500. So that's the gist of it. And I'm going to review these 20 stocks to you one by one. But before we do, here's an announcement. Today's episode is brought to you by FinBite Insights. So this FinBite Insight is started by Alvin, and that's me. And each day I will articulate my thoughts about the financial markets. Just by reading in less than 3 minutes, you will be able to get a very good understanding about what's going on, what's the most important thing that you need to know about the financial markets for that day, and how do you interpret it so that you can make better investment decisions out of it. So do remember to go to finbiteinsights.substack.com and you can subscribe it for free and start enjoying the daily insights that I'll deliver it to your inbox. Okay, welcome back, and now we will start our countdown. The very first stock at number 20 is Salesforce. You should be quite familiar with this name. They are known for sales and marketing SaaS, or software as a service business, and companies who are really serious about their sales would definitely want to use Salesforce. Okay. And in terms of their growth rate, if we can take a look at the past 10 years, right, majority of the years we were able to see that they grew more than 20% per year, right? Look at the purple line, that is the revenue growth rate, and the blue line is the revenue per year, and you can see it's a consistent trend that's going up. And Goldman Sachs also project that Salesforce will able to grow its revenue by 11% per year until 2025. So there is a little bit of deceleration in latest years, but even if they can sustain that 11%, they will have qualified the rule of 10 principle that Goldman Sachs have established. And I also wanted to add in a little bit of valuation to help you understand whether some of these stocks are worth looking at this point in time. And how I do it is that I'll use simply a price to sales ratio, because since we are talking about revenue, right, Goldman Sachs filtered it based on revenue growth. I also wanted to use a price metric that will benchmark against the revenue, and that's why price to sales is being used. And I'll just compare to the past historical 5 years of the price to sales trading range. And if, let's say, the share price is below the fair price, which is the average price to sales, I will deem it as undervalued. Okay, so for Salesforce, it's considered undervalued because the price to sales is at 6.4 times, while the average was at 8.7 times. So it is below the average price to sales, and that's how I want to use that to determine whether is it undervalued or overvalued. But of course, this is a simplistic way of doing things. Some investors may want to look at more indicators to really determine whether a stock is indeed undervalued. So in number 19, we have this Aptiv. This is probably less known to investors, but it is an important company. It produces automotive components, especially in terms of the electrical wirings, right? So in a car, and it's also a supplier to Tesla and General Motors as well. In terms of growth rate, you can see it is more volatile, right? Some years they even have a drop in revenue growth. It is not as nice as what we have saw in Salesforce. Okay, some years it can go up to 52% growth in 21.8 from a year ago, right? So it fluctuates a lot, but Goldman Sachs believe that going forward, average it will be around 11% per year till 2025, right? So I'm not so sure about that, actually, looking at the growth performance of this Aptiv. In terms of valuation, is also undervalued, right? Price to sales at 1.5 times, while the average is at 1.9 times. Next up, we have Starbucks. Okay, another company that we do not need any further introduction. Is the world's largest coffee chain. And in terms of the growth trajectory, let's take a look, right? So it can really grow more than 10% in most of the years in the past 10 years. Yes, there was a dip in 2020, and that's acceptable because of COVID outbreak, lockdowns. A lot of all these retail shops are not open. So for that year, we can actually excuse Starbucks. Then thereafter, when it reopens, reopened, it managed to grow past the pre-COVID revenue figures and continue to grow from there. So it is quite encouraging, right? And Goldman Sachs also project it to grow at least 11% per year in the next 2 years. So is Starbucks overvalued, undervalued? So it's slightly undervalued, right? Because the price to sales is at 3.3 times, while the average is at 3.9 times. So it's slightly below the average price to sale that it has been trading for the past 5 years. At number 17, we have Monster Beverage. You might see this in the supermarkets, and they mainly do energy drinks like alternative to Red Bull. And this is the growth rate for the past 10 years. The revenue has also been steadily growing every year, and the growth rate for the revenue has been able to go above 10% for most of the year, again except 2020, right? Even though for that year they still managed to grow the revenue at 7.6%. And for Goldman Sachs projection is about 12% growth for its revenue until 2025. Okay. So valuation is slightly overvalued at 9.8 times for its PS ratio, while the average was just 8.9 times. At number 16, we have Cadence. This is probably also a less well-known company, but it is also playing a very crucial role. In this case, it's in the semiconductor industry. So when, let's say, the chip designer like NVIDIA or even Apple want to do their chip design, they will need softwares, and Cadence is one of the key software providers. Of course, there are other competitors like Synopsys. And in terms of the revenue growth, let's take a look. Last 10 years, again, the blue line, you can see the revenue has been growing very steadily. Every single year it goes up. And in terms of the revenue growth, it is usually most of the time growing at single digit, but in the last few years, especially from 2021 onwards, you can see that there was acceleration in the revenue growth, probably driven by, again, all the AI developments, especially more chip designers are coming to the fore, right? Even Apple design their own chips, Amazon, Alphabet wants to design their own chips, so they get more customers in that way, and that's why the revenue has been growing. So that is a good sign for this Cadence, and definitely the share price is very overvalued. The PS ratio is at 17 times as compared to the 5-year average is at 11.6 times. At number 15, we have Adobe, another popular name you should know, and you might be even using some of their programs, right, like Photoshop, Illustrator, or even the plain old PDF, right? The format was invented by them. And this is the revenue growth, again very steady, the blue line, every single year it goes up, and it has been able to maintain more than 20% revenue growth per year in most of the years in the past 10 years. And recent years we see some dip, right, some slowdown, but I always believe that it's normal, because as the revenue base grows bigger, your growth rate usually cannot sustain a very high rate. And Goldman Sachs still project that it will grow at 12% per year until 2025. So this is another stock that passed the rule of 10 criteria. In terms of valuation, it is undervalued. The price to sales is at 12 times, while the average has been trading around 14.6 times in the past 5 years. At number 14, we have Intuit. So Intuit is more popular in the US, especially for small business owners, because they provide accounting software like QuickBooks. They also have the tax management like TurboTax. Even for individuals, they have Mint that help you manage your own personal finances and track your investments or spending. And they also have Credit Karma, where they help to compare products for individuals to choose. And recently they also acquired MailChimp, which is a marketing software, and is an add-on to the small business owner, right, who need to market their business to more customers. So this is another software company. And in terms of growth rate, a lot about this software company, you can see that they are rather resilient in their growth, right? They are able to grow their revenue every single year in the past 10 years. And for the growth rate, majority of the time is above 10%. And Goldman Sachs forecasts that it will grow its revenue at 13% per year until 2025. In terms of valuation, it is undervalued at 9 times PS ratio, while the average was 11.2 times in the past 5 years. At number 13, we have Chipotle Mexican Grill. This is a Mexican fast food chain in the US, very popular because they have a big population of Hispanics. And this Chipotle will have catered to their preference for food, Mexican food, and like burritos and those bowls, those salads. So this is something that's very different from the McDonald's and the KFCs. In terms of growth rate, it has been steadily growing as well, except for years in 2016. I think there was some hygiene or health issues plaguing the company, but they have recovered from that largely. And they've been able to grow above 10% for most of the years. And Goldman Sachs project that they will grow at 14% in the next 2 years. So as I go through the stocks, you realize that their growth projection goes higher and higher. Okay, so that is how I rank them. In terms of valuation, it's overvalued. The price to sales ratio is at 6.5 times, while the average is just at 5.1 times in the past 5 years. At number 12, we have Ceridian, CDAY, and this is a human capital management SaaS, okay, software service, and basically it helps those HR professionals to handle the human resource within the company, right? The profiles of the employees, when they take leave, benefits, bonuses, etc. Okay, so it's anything pertaining to the HR function. In terms of revenue growth, there was an acceleration. You can see the purple line, right? It just keep jumping up. Okay, and it started slow, but now it's growing like more than 20% per year. So there was a acceleration after, especially 2021. Okay, after the COVID struck. And Goldman Sachs project that they will grow at 16% per year in the next 2 years. In terms of valuation, the PS ratio average was at 11.3 times and currently is trading at 7.7 times, so it is undervalued, right? Even though the revenue has grown, the share price have not really go up in tandem. And 11, we have Arista network, so they do high-speed switches as well as routers. Okay, the major player in this space is Cisco, but Arista stood out because it focuses on the high-speed one, the high-end ones. Okay, so and hyperscalers or data centers, the speed is important. They would likely use Arista products. And looking at their growth rate, it has been fabulous, right? They've been growing above 30% for most of the years. Goldman Sachs project that it will grow at 16% per year for the next 2 years. In terms of valuation, it's fairly priced. PS ratio is at about 10 times, while the average is about 9.7 times. So it's very close to the average, just slightly above. And at number 10, we have Axon Enterprises. So they make tasers. So it's those like guns that give electric shocks to those suspects, okay? Instead of using bullets. So relatively it's less lethal in that sense. And the revenue growth has been fantastic as well. Every single year it has managed to grow, and the average growth rate has been able to sustain above 10%. Right, so this is quite impressive. I never knew tasers can sell so well, and Goldman Sachs projected that it will still continue to grow at 19% per year until 2025. In terms of valuation, we can see it's also about fairly priced. Price to sales is at 11.3 times, while the average is at 10.6 times. Okay, so it's within that range. And at number 9, we have Insulet, which is an insulin delivery system. So it's more for those having diabetes, right? Those chronic diabetes problem, and they need insulin injection. And this is the device that help them do it. And in terms of the revenue growth, again, very impressive. Every single year, the revenue has grown, and the growth rate has also been able to sustain 20% and above for majority of the years. And Goldman Sachs believe that this growth rate will sustain at about 19% per year until 2025. As for valuation, it's also about fairly priced. Price to sales is at 14.4 times, while the average is at 15.4 times. At number 8, it's also related to diabetes. This is a monitoring system, right, to monitor the sugar level. Probably this is for less serious diabetes patients where they do not really need regular insulin injection, but they do need to monitor their glucose level. So this is where Dexcom comes in. And revenue growth has been consistently on the rise, even though the growth rate has slowed down, right? You can see the purple line is a declining trend, okay, but it still managed to grow above 20% per year. And Goldman Sachs believe that it will still be able to achieve that 20% per year until 2025. So for valuation, fairly priced, 16.3 times PS ratio, average is at 16.6 times. Okay, so this is also another fairly priced company. At number 7, we have Fortinet, a cybersecurity company. It does both hardware and software. So the bigger companies where they need an integrated solution, they will probably go for companies like Fortinet because they take care of both the hardware and the software. And the big companies don't need to deal with many different vendors and may even have problem integrating them together. As for revenue growth, very fantastic as well. You can see there's almost like a hockey stick effect where there's an acceleration of growth in the earlier years between 21.4 to 21.7, and then a re-acceleration between 2021 and 2023. Revenue growth has been above 20% for majority of the years, and Goldman Sachs projects that it will still grow at 21% per year until 2025. As for valuation, it is fairly priced, PS at 12.2 times, while the average is at 10.6 times. Number 6, we have Paycom. This is similar to what we saw just now with Ceridian, but this is more focused on the payroll itself. Okay, so managing the pay and bonuses for customer. This is a subscription software. Revenue has grown well, grown every single year in the last 10 years. Revenue growth has sustained above 30% for majority of the years. So you can see it's quite fast. But Goldman Sachs project that going forward, maybe give a little bit more conservative estimate. It will still grow at 21% per year until 2025. As for valuation, it is undervalued now. The price to sale is at 12.6 times, while the average has been around 20 times. Okay, so revenue has been growing, but share price has been going down. Of course, please do some due diligence to understand what's going on and make sure that there's no major issues for Paycom. And number 5, we have ServiceNow. This is an IT operation and service management software, right? More for the IT department. If let's say any employee meet into some IT issues, they will raise a ticket and the internal IT department can handle it, improve workflows. So this is the software company that does it for the clients. And in terms of revenue growth, it has been steadily climbing in the last 10 years. And the growth rate has been steadily declining as well, but still impressive because it has managed to grow above 30% for majority of the years. But Goldman Sachs project that the growth rate will continue to slow down, but stabilize around or average around 22% per year until 2025. As for valuation, it is slightly undervalued. Price to sale at 15 times, while the average is at 17.8 times in the past 5 years. Number 4, we have Palo Alto Networks. This is another cybersecurity company. This is a key competitor to Fortinet. So it does both hardware and software solutions together, right? Integrated approach, just like Fortinet. For revenue, it's equally impressive with Fortinet, and growth has been sustained above 20% for majority of the years. Goldman Sachs project, it will grow at 22% per year in the next 2 years. As for valuation, it's also very overvalued as with Fortinet. Okay, so it is an industry kind of overvaluation, not just for Fortinet, but Palo Alto Networks seeing this effect as well. Average PS ratio was 8.8 times for the last 5 years, but now it is trading at 12 times, which is way higher than where the average should be. And number 3, we have SolarEdge. So this is a solar energy company, more for the retail customers. That means if you have a house and you want to set up your solar energy generator, I want to go for SolarEdge, and that's where they come and install. Again, a turnkey solution. They have the solar panels, they have the inverters, and also the software to control the system. So for SolarEdge, the key device is actually the inverter. So what does the inverter do? It actually changes the DC to the AC power. And why is that important? Because mostly our device is based on AC, right? That's how the grid transmit the electricity. So without which, we need to change all our devices. So this inverter makes it convenient for whatever device that we've been using on a day-to-day basis. And for revenue, it has also been climbing, and especially it has accelerated since 2021, probably due to the cost of solar panels have gone down, the adoption has went up, the price of oil has gone up. That's also spur consumer to consider solar, right? Instead of paying high prices for electricity bill, now they can lower it by installing all this solar energy within the house. And the revenue growth has been very fast as well. In some years, they have gone up like 60%, 50% revenue growth, but it is rather volatile. And in other years, they have grown just 10%. Goldman Sachs project that revenue will grow average of 24% per year in the next 2 years. When it comes to valuation, the price to sales is at 4.5 times, and the average price to sales was at 5.8 times in the past 5 years. So it's slightly undervalued, I would say, in this case. And number 2, we have Tesla. Okay, this company don't need much introduction to. And the revenue has been growing, and the revenue growth has also been impressive, right? Averaging like 30% and above for majority of the years. And Goldman Sachs project that it will still grow at 26% per year until 2025. Okay, so it is already one of the Magnificent Seven, and yet the growth rate is still continuing to be at a high pace. And in terms of valuation, due to the very fast rebound since Tesla slided a lot in 2022, it is now about fairly priced. Price to sales is 10.3 times, while the average is also at about 10.3 times. And finally, we are now to number 1, which is Enphase Energy, another competitor to SolarEdge that provides the solar energy solutioning to homes. Okay, so they also do the inverters. And in terms of the revenue growth, is also very impressive. It's equally impressive as SolarEdge has managed to grow and accelerate after COVID has struck. And revenue growth has also been very volatile, right? Some years they actually have a dip, then some years they managed to grow at 60%, 70%. But from that 2020 after COVID, it has managed to grow above 40%. But Goldman Sachs probably inject some conservativeness, and the revenue projection going forward is about 27% per year. In terms of valuation, similarly, it's slightly undervalued. Average was 13.7 times for its PS ratio, while the current PS ratio is 8.9 times. So we finally come to the end, the 20 stocks that have been screened out by Goldman Sachs using their rule of 10 criteria. That means the revenue growth has been able to sustain more than 10% going forward, not just backwards, going forward. Very important, okay? But these are just for trade idea generation. Hopefully you find some ideas interesting and you want to do a bit more due diligence on them. Never buy directly just because of a stock screen itself. So if you are interested to find out more, do visit finbiteinsights.com. I've also included the link in the description. And also not forgetting, subscribe to this YouTube channel and give me a thumbs up for this video. Thank you for watching and goodbye.